It began like any other Monday. The hum of the trading floor was a familiar symphony, a blend of voices, ringing phones, and the occasional burst of laughter. Traders sipped their coffee, eyes glued to flashing screens. The morning routine was in full swing, with everyone settling into their roles, unaware of the storm brewing on the horizon. Then, the floor seemed to drop out from under the market, a sudden sharp decline that sent shockwaves through the room. The S&P 500, a bellwether for American stocks, plummeted. It was as if the ground had shifted beneath their feet, leaving them scrambling for answers. By the closing bell, it had shed nearly 7% of its value, its largest single-day drop in years. The atmosphere was thick with tension and disbelief. The tech-heavy NASDAQ fared even worse, down a staggering 8.2%. Panic set in. Traders exchanged worried glances, their minds racing with the implications. Whispers of 2008, of Black Monday, filled the air. The memories of past crises resurfaced, adding to the growing sense of dread. But then, just as quickly as it had fallen, the market rebounded. It was a roller coaster of emotions, leaving everyone breathless. On August 7th, the S&P 500 clawed back nearly half its losses. The NASDAQ followed suit. Relief washed over the trading floor, but it was tinged with uncertainty. Had the storm passed, or was this merely the eye of the hurricane, a brief respite before the real chaos began? The questions lingered, unanswered. The truth, as always, was more complex. Beneath the surface, forces were at play that few could fully comprehend. This wasn't just another volatile day on Wall Street. It was a sign, a harbinger of things to come. This was a tremor, a sign of deeper tectonic shifts in the global economy, the kind of shifts that could reshape the financial landscape. To understand what happened, we need to look beyond the numbers, beyond the algorithms and the trading desks. We need to delve into the underlying currents. We need to understand the forces that drive the market, the human emotions, and the global currents that converge in this vast interconnected casino we call the stock market. Only then can we begin to grasp the true nature of what unfolded on that fateful day. The tremors weren't confined to Wall Street. The ripple effects were felt far and wide, shaking the very foundations of global finance. Across the globe, markets shuddered. The interconnected web of global finance meant that no corner of the world was immune. Japan's Nikkei 225, already reeling from a weakening yen, plunged by over 5%. The shockwaves were immediate and severe. European markets followed suit, with the FTSE 100 in London and the DAX in Frankfurt both down significantly. The decline was swift and unrelenting. Even emerging markets, often seen as a haven during times of turmoil, weren't spared. The supposed safe harbors were rocked by the storm. The interconnectedness of the global economy meant that no market was an island. Every market was a piece of the larger puzzle, and when one piece faltered, the whole picture was affected. A sneeze in New York could give Tokyo a cold. The symbiotic relationship between these financial giants was undeniable. And on August 6th, it felt like the world had come down with a nasty flu. The sense of panic was palpable, and the fear was contagious. Taiwan's main stock index, heavily weighted towards technology companies, mirrored the NASDAQ's fall. The reason? Fear. Fear of the unknown and the unpredictable. Fear that the engine of global growth, the tech sector, was sputtering. The once unstoppable force now seemed vulnerable. Fear that the AI-fueled boom that had propelled markets to dizzying heights was built on hype rather than reality. The bubble seemed ready to burst.
Fear is a powerful driver in the market. It can override logic and reason, leading to irrational decisions. When investors lose confidence, it can create a cascade of selling, a domino effect that is hard to stop once it starts, a self-fulfilling prophecy of sorts. The more people sell, the more prices drop, and the more prices drop, the more people sell. The tech sector, once seen as invincible, suddenly looked vulnerable. The cracks in the facade were becoming more apparent, and that vulnerability spread like wildfire across global markets. The fear and uncertainty were universal, affecting every investor and every market.
To understand the role of fear and perception in all of this, we need to turn to George Soros, the legendary investor who famously broke the Bank of England. Soros's theory of reflexivity argues that market participants' biases and perceptions can shape the fundamentals they are trying to predict.
In other words, it's not just about the numbers, it's about how those numbers are interpreted, how they make people feel, and how those feelings translate into action. Think of it like a self-fulfilling prophecy. If enough investors believe the market is headed for a downturn, they'll start selling, which can in turn trigger a real downturn, regardless of the underlying economic fundamentals. This is precisely what we saw on August 6th. The initial trigger, as we'll explore later, might have been a policy shift in Japan, but it was the market's reaction to that trigger, amplified by fear and uncertainty, that turned a tremor into an earthquake.
Soros's theory is often criticized for being too abstract, too difficult to quantify. But in the aftermath of August 6th, it's hard to deny the role of sentiment, of fear and greed in driving the market's wild swings. The market's mood swings are not just numbers on a screen. They are the collective emotions of millions of investors. When fear takes hold, it spreads like wildfire, causing panic selling and sharp declines. Conversely, when optimism reigns, it can lead to irrational exuberance and soaring prices. Understanding this emotional component is crucial for anyone looking to navigate the financial markets successfully. It's a reminder that markets are not just driven by cold, hard data, but by the very human emotions of those who participate in them.
The AI mirage, hype, valuations, and the bubble that burst. One of the key drivers of market sentiment in recent years has been the rise of artificial intelligence.
AI, we were told, was going to revolutionize everything. From self-driving cars to personalized medicine, the possibilities seemed endless. And investors, eager to get in on the ground floor of the next big thing, poured money into AI-related stocks. Valuations soared to stratospheric levels, often detached from any reasonable assessment of future earnings. Companies with little more than a catchy name and a PowerPoint presentation about their AI ambitions were suddenly worth billions. It was a classic bubble, fueled by hype, speculation, and the fear of missing out.
And like all bubbles, it was bound to burst. The trigger might have been Japan's policy shift, but the underlying fragility was already there. The market, drunk on AI Kool-Aid, had become detached from reality. August 6th was a wake-up call, a reminder that hype can only sustain valuations for so long. Eventually, gravity takes hold. The carry trade unwinds Japan's policy earthquake. So what was the trigger? What caused the initial tremor that sent shockwaves through the global financial system?
The answer, surprisingly, lies in the seemingly arcane world of central bank policy and a trading strategy known as the carry trade. The carry trade is like financial arbitrage on a global scale. Investors borrow money in countries with low interest rates like Japan and invest it in countries with higher interest rates, pocketing the difference. For years, Japan's ultra-low interest rates, designed to stimulate its sluggish economy, made it a prime source of cheap money for carry traders.
But on August 5th, the Bank of Japan, in a surprise move, hinted at a shift away from its ultra-loose monetary policy. The yen, long depressed by low rates, surged in value. This threw a wrench into the carry trade machinery. Investors who had borrowed cheaply in yen were suddenly facing higher repayment costs. They started selling their dollar-denominated assets, triggering a domino effect that reverberated across global markets. Main Street on edge, jobs, savings, and an uncertain future. The events of August 6th weren't just an abstract financial drama playing out on Wall Street. They had real-world consequences for everyday people.
Retirement accounts, already battered by inflation, took a hit. Job security, particularly in sectors sensitive to economic downturns, suddenly seemed less certain. The fear was palpable. Would this be a repeat of 2008? A full-blown financial crisis that would send the economy into a tailspin? Or was this a correction? A painful but necessary adjustment after years of exuberance?
The answer, as always, was shrouded in uncertainty. The economy, like the stock market, is a complex system driven by a multitude of factors, both rational and irrational. Predicting its course is more art than science. Navigating the rubble advice for the perplexed investor. So, where does this leave the individual investor? The temptation in the face of such volatility is to panic, to sell everything and hide under the mattress. But panic is rarely a sound investment strategy.
Instead, take a deep breath and remember the following. Don't try to time the market. Trying to predict short-term market movements is a fool's errand. Even the experts get it wrong more often than not. Focus on the long term. Investing is a marathon, not a sprint. Ride out the short-term fluctuations and focus on your long-term financial goals. Diversify your portfolio. Don't put all your eggs in one basket. A well-diversified portfolio can help mitigate losses. Seek professional advice. If you're unsure about what to do, consult with a qualified financial advisor.
The events of August 6th were a stark reminder of the market's capricious nature, but they were also a reminder that the best investors are those who keep their cool, stick to their plan, and remember that the only certainty in the market is uncertainty itself.